Okay, everyone, Assalamu alaikum, and welcome to ACCA's Prepare to Pass session for paper SBR, Strategic Business Reporting. I'm your trader, Hamza Abdul Haq, and today is day number 4. We have covered 3 days so far, and in the first 2 days, we had covered the area of consolidation. In day number 3, we have covered different accounting standards, which includes IFRS 15, IFRS 16, and we have solved one of the questions relating to the consolidation. Now, in today's session, our main objective is to cover the big standard, which a lot of students actually face problem in, which is IFRS 9 financial instruments. Plus, we are going to discuss some different accounting standards as well. So let's start from IFRS 9, which is financial instruments. In this, basically, there are total 3 standards. The first one is IAS 32, which talks about the presentation, which means identification and the definitions of financial asset, financial liability, or equity. And the second standard is IFRS 9, which actually discusses the accounting treatment of the financial assets and the financial liabilities. And then we have the third IAS by the name of IFRS 7, which actually talks about the disclosures. So let's start first from the definition of financial asset. This is a part of IAS 32. When we say financial asset, what exactly is financial asset? Financial asset is cash, equity instrument of another entity. So if we have acquired the ordinary shares of another entity or irredeemable preference shares of another entity, we call that a financial asset because for the issuer, it's an equity, and for us, it's a financial asset. So when we say financial instruments, actually what happens is financial instrument is a financial asset for one entity and a financial liability or equity of another entity. Like let's suppose that I have a receivable balance from you. If I have a receivable balance from you, it's a receivable for me, a financial asset, and it is a payable for you, a financial liability. So these receivables and payables are called financial instruments because it is an asset of one party and a liability of the other. Similarly, if I have acquired shares of a company, it's a financial asset for me and the equity of another entity. So the instruments, which is an asset for one entity and equity or liability of another, is called a financial instrument. Similarly, if company A has issued loan notes to company B, so this means that it's an asset for financial asset for company B, and it's a financial liability for company A. So it's an asset for one entity and a liability of the other entity. So these loan notes are going to be called a financial instrument. But let's say if we talk about a plant, plant is an asset for one entity, but it is not a liability or equity of anyone else. So the assets which are not a liability or equity of anyone else, that is a non-financial instrument. Getting the point, everyone? I cannot see your questions. Let me open that. Okay, now I can see the questions of you people. Usama is asking where to ask questions. Usama, you can ask your question over here because I can see your message. Walaikum assalam, Ali Kiani. Sabai saying, so where can I find Carson question for the practice you gave us yesterday? Okay, Sabah, I will open the question on the screen in a while, and then you can take the snapshot of that. Walaikum assalam, Zadar. Salman is saying Carson is also in the kit. Okay, so now let's get back to the definition of the financial asset. So financial asset is cash, equity, instrument of another entity, which means ordinary share capital or irredeemable preference share capital of another entity. Apart from that, if we have a contractual right to receive cash or another financial asset, that is also called a financial asset. So the examples of this is basically trade receivables, and the example actually includes the loan notes or the debentures that we have acquired. Acquirer is the one who gives the loan and issuer is the one who receives the loan. So if I have purchased the loan notes of someone else, I have given them the loan and it's my right to receive my cash back. So any contract in which we have a right to receive cash, that is called a financial asset. No, Sumaira, there's nothing else other than the financial instruments so far. The next thing is a contractual right to exchange financial assets or financial liabilities under terms potentially favorable to the entity. This point mainly refers to the derivatives actually. All of the derivatives which are favorable to us are going to be a financial asset. Like let's suppose that I'm a party, I go to the bank and I sign a forward rate agreement with the bank, a 2 months FRA that I'm going to purchase dollar for let's suppose, or I'm going to purchase pounds for let's suppose $2 per pound. I'm going to purchase pounds for $2 per pound. This is a contract that I've signed with the bank. Now let's suppose after 2 months, the market rate actually fluctuates and it becomes $3 per pound. So what will happen? I will go to the bank taking how much? Taking $2 for the pound. And I'm going to the bank giving $2 and getting a pound of $3. I'm giving $2 to the bank and I'm going to get a pound of $3. So I'm giving cash in dollars, I'm receiving cash in pounds. So it is an exchange of financial asset where it is favorable for me because I'm giving $2 and getting a pound of $3. So according to this point, all of the derivatives which are favorable to us are going to be classified as a financial asset. And if these derivatives are unfavorable, they will be classified as a financial liability. And then a contract that will or may be settled in an entity's own equity instrument for which the entity is obliged to receive a variable number of its own equity instrument is also classified as a financial asset. Now, this is something which is quite difficult to understand. Ahmed is saying, can you repeat the derivative point? Okay, Ahmed, let me open the OneNote first because that will be more easier for us to understand. So I go to Microsoft Office and OneNote. Okay, so now today we are going to discuss Ifrs 9 and we are right now talking about derivatives. Basically, let me give you an example again that I'm a person A and I go to the bank and I sign a contract with the bank which is a forward rate agreement. Forward rate agreement means that I'm going to buy something in the future and it's a 2 months forward. This means I'm going to buy something after 2 months. And we lock a rate that I'm going to purchase 1 pound for how much? For $2. It's an exchange rate. I'm going to take 2 pounds to the bank and get $1 after 2 months. This is my agreement with the bank. Now what happens after 2 months? After 2 months, the market rate actually changes. And now in the market, the pound is of $3 each. But according to my contract, I can purchase the pound for how much? For $2. So I'm going to the bank. I'm going to the bank taking how much? Taking $2. And in return, what I will get from the bank? I will get £1. Agreed so far? I'm going to the bank after 2 months and I'm giving $2 to the bank, and in return I'm getting £1. Now this £1 has a market value of how much? $3. So this means that I am giving cash to the bank and I'm receiving cash from the bank in return. So it is an exchange of financial assets. I'm giving cash, which is a financial asset. I'm receiving pounds, which is a financial asset. So it is an exchange of financial assets where I am in a favor. Why? Because I'm giving $2 and I'm getting a pound which has a market value of $3. So I have a gain of how much? $1. So this means that this is a derivative which is favorable to me. Getting the point, everyone? So any derivative which is favorable to us is called a financial asset. Getting this now? Yes, Sam, we can say that. SBI has got the point. Okay, a lot of people are getting it now. So good. So according to this bullet, we say that exchange of financial assets or financial liabilities under terms potentially favorable means all of the derivatives which are favorable to us will be called a financial asset. And normally what type of derivatives do we have? We have in total 4 types of derivatives. A forward rate agreement is a derivative. Futures are a derivative. Options are a derivative and swaps are a derivative. This is something which you would have studied earlier in your paper financial management, which was previously known as the F9. Yes, David, today's session will be available in the recorded form as well, so you can view the recorded lectures tomorrow. They will be uploaded on Vimeo tomorrow. Okay, so now let's get back onto the definition, which actually says one more thing, that if we have a contract that will or may be settled in an entity's own equity instrument, for which the entity is obliged to receive a variable number of its own equity instrument, such contracts will also be classified as a financial asset. Now, this is something even more difficult to understand. Let me give you an example for this on the OneNote again. That let's suppose I am a party A and I go to a party B and I have, let's suppose, a building which I am planning to sell. I go to B and I ask B that, do you want to buy the building from me? It is of $100 million. B says, okay, I am willing to buy, but in return, I'm not going to give you cash. I will give you your own shares. B is saying to A that I will give you your own shares. This means it is a contract which is going to be settled in shares of A. A will give the building to B and B will give the shares of A by purchasing it from the market. Now the question arises that how many shares will B actually give? If B gives fixed number of shares, let's say 10 million shares, this means that the shares are fixed. And B may say that, okay, I'm going to give you variable number of shares after 6 months. I'm not giving you shares today. I'm going to give you shares after 6 months. How much? I'm going to give you 10 million shares. This means the number of shares are fixed. And if B says I'm going to give you variable number of shares, this means B will give the number of shares of worth $100 million. Shares worth $100 million. So if the share price at that time is $10, A will give how many shares? 10 million shares. If the share price at that point of time is $20 per share, A will give how many shares? 5 million shares. And if the share price at that time is $40 per share, A will give how many shares? 2.5 million shares. So exactly how many shares is B going to give? We do not know right now. These shares are actually variable in nature. The price after 6 months will actually decide the number of shares which B will give to A. So there are two possibilities in this case. Either B will give 100 million shares or B will give variable number of shares. So if the number of shares are variable, this means that A is going to make an entry as the building credit and the financial asset debit if the number of shares given by B are going to be variable. And this entry is going to be made by how much? By $100 million. Because A is giving a building of 100 million and in return getting shares worth how much? $100 million. So both the values are exactly $100 million. So we are going to record it at that value. But if B says that I'm going to give you fixed shares, in that case, A should make an entry as the building credit and equity debit. So if the number of shares in this are variable, we treat it as a financial asset. And if the number of shares are fixed, we treat it as a part of equity. Okay, Mohammed Saqib is saying this transaction may give the shareholder to save their self and acquire the assets of the company in case where the company is. Yes, Mohammed Saqib, this can be the case. So in case of variable number of shares, we are going to record it as a financial asset, and in case of fixed number of shares, we are going to record it as an equity. Exactly, Tasbih. It depends on the number of the shares. Ali Kiani is saying, why not IFRS 2? Ali Kiani, I'm going to answer your question in a while. Jagmeet is asking, sir, what is the logic behind this one asset and one equity? Basically, there can be different logics, but right now, what is important is not the logic rather than the accounting, because this is what IAS 32 asks us. Okay, now if I go back to the definition, this means any contract where the contract will be settled in my own equity instrument, then we have to see whether the number of equity instruments are variable or fixed. If they are variable, it's a financial asset. If they are fixed, it's an equity. Yes, Tridhar, you are right. Yes, Ajmal, you are saying that for fixed, not it be 100 million. Mohammed Ajmal, are you talking about the amount or the shares or what? Okay, meanwhile, let's continue with the definition of financial liability, which says that financial liability is a contractual obligation to deliver cash. The financial asset was a right to receive cash, and the liability is a contractual obligation to deliver cash or another financial asset. So if we are liable to give cash, like such as payables, it is a financial liability, or such as any loan notes or debentures which we have issued, This means that we have received the loan and we need to repay it back. So from the issuer point of view, it is a contractual liability to deliver cash. Yes, Salman, I think I've covered the IFRS 2 in the previous webinar. The second point is that financial liability is a contractual obligation to exchange financial assets or financial liabilities under terms potentially unfavorable to the entity. So again, if we are talking about a derivative, derivatives can either be favorable or unfavorable. Favorable means that we have a gain and unfavorable means we have a loss. So all derivatives where we have a gain is a financial asset, and all derivatives where we are at a loss is called a financial liability according to this point. So these 2 points are pretty much similar to the asset side that we have just discussed. The next thing which says that a contract that will or may be settled in an entity's own equity instrument for which the entity is obliged to deliver a variable number of its own equity instrument. So this is again similar to the previous one. If I go back, here we were receiving variable number of our own equity instruments, and in case of liability we have obligation that we are going to deliver the variable number of own equity instrument. So the only the only difference is that if we are receiving our own shares, we call it as a financial asset, and if we are going to issue our own shares, we are going to call it a financial liability if the number of shares are variable. And if the number of shares are fixed, this will always be an equity. So any contract which is being settled in our own equity instrument needs to be checked whether we are receiving it or whether we are issuing it, plus whether the number of shares are fixed or variable. Then we decide to the accounting treatment. Now let's suppose if I go back again onto the example and I make a similar example again, that I am an entity A, I go to B, and B actually has a building of its own, and we ask B that we want to buy the building from you. In my previous example, the building was with A, but in this one, we have changed it a bit. A goes to B and says that, hey B, I want to buy your building from you. B says that the building is worth $100 million. Can you pay that? A says that I'm not going to pay you cash of $100 million. Instead, I am going to give you my own shares of A. This means it is a contract which is going to be settled in A's own equity instrument. Now B says, okay, how many shares will you give? A says that I'm going to give you fixed shares, let's say 10 million shares of mine after 6 months. This means that the number of shares are fixed. In this case, A should recognize an entry as the building debit and the equity credit, because whenever the number of shares are fixed, we are going to call it an equity. And if the number of shares are variable, where A says that I'm going to give you shares of worth $100 million, which means if the share price is $10, we are going to give 10 million shares. If the share price is $20, we're going to give 5 million shares. If the share is $40 after 6 months, we are going to give 2.5 million of the shares. So we ourselves don't know exactly how many shares are we going to give. So in this case, we say that it is a financial liability and the entry should be building debit and the financial liability credit. So the only difference between both the cases is that if the number of shares are variable, we call it a financial liability. If the number of shares are fixed, we call an equity. And this is a case which is not going to be dealt by IAS 32 or IFRS 9. This is going to be dealt by IFRS 2 because it is going to be treated as a share based payment. This is going to be treated as a share based payment. So only where we are issuing the shares which are variable, which are fixed in numbers, we treat it as the share based payment transaction. Yes, Nabia, we are talking about the number of shares irrespective of the market value. So we can summarize it this way, that if we are talking about our own shares, there are two possibilities. Either we are going to receive our own shares or we are going to issue our own shares. If we are receiving our own shares, either we are going to receive fixed shares or we are going to receive variable shares. Similarly, if we are issuing, again, either we will issue fixed shares or we are going to issue variable shares. In case where we are issuing fixed shares, we are going to make an entry as the asset, debit, and equity credit, which will be IFRS 2. And if the number of shares are variable, we are going to debit the asset and we are going to credit the financial liability, which will be dealt as IFRS 9. And if the number of shares we are receiving is fixed, we are going to make an entry as equity debit and the asset credit. And this is also known as treasury shares. This is also known as treasury shares, where we receive our own equity instruments. And if the number of shares are variable, we are going to make an entry as financial asset debit and the asset credit, which is going to be dealt under IFRS 9. And the accounting for the treasury shares is under IAS 32. So this is a complete summary of where the accounting treatment is going to be when we talk about our own equity instruments. Getting the point, everyone? This is a quite detailed concept which you're not going to find in any book. People normally just write the definition and go further. So this is one of the areas where the students actually feel problem. Okay, good enough. Great. Okay, so let's move further on to the presentation back. So now we have understood the definition of a financial asset and the definition of financial liability. Merrick, this is a type of a section B type question mainly. Financial instruments is something which is favorite of the examiner in section B. Okay, so now let's move further. The next thing that we are going to discuss is going to be the classification of financial assets. Normally, we have three categories of the financial assets. One is the fair value through P&L, the other is the fair value through OCI, and the third one is the amortized cost category. So in total, financial assets can be classified in these three categories. Now, when we say financial asset, it is either an equity instrument of another entity or it is going to be a debt instrument of another entity. Because financial instrument is my asset and either equity of the other or the debt of the other. So financial asset is either an equity or a debt for the other party. So if we talk about an equity instrument of another entity, these can be classified in only two categories: fair value through P&L and the fair value through OCI. These cannot be classified in the amortized cost category. Yes, Jagmeet, we can say that loan note is a type of a debt. Exactly. Now, if we have purchased the equity instrument, which means the shares of another entity, if my intention is short term, we are going to classify it in the fair value through P&L category. And if my intention is long term, we are going to classify it in the OCI category. So the classification of financial assets actually depends that whether my intention is short term or is it a long term intention. If it's short term, we classify it in P&L. If it's long term, we classify in the OCI. But let's suppose that I have acquired the shares of an entity, but I'm still not confident myself whether my intention is short term or long term. I'm thinking that if the share price increases significantly, I will sell it. Otherwise, I will keep it for long term. So in which category should we classify in this case? If I myself am not sure that what exactly my intention is. So we should classify in which category? Tasbih is saying P&L, Abdul Qadir is saying OCI, Johnson P&L, Vishal OCI, a lot of P&L, one amortized cost, super. Okay, basically we are going to classify this in fair value through P&L category because we say that fair value through P&L category is the default category. In case of any confusion, we are going to classify the instrument in fair value through P&L. So in both the categories, we treat fair value through P&L as the default category. So in case of any confusion, we are going to classify it in the fair value through P&L. Plus, we also say that we have a fair value option in fair value through P&L category, which means that even if my intention is long term, but I still want to classify it in fair value through P&L, I can. This fair value option rule says that any financial asset can be classified at fair value through P&L category. Jagmeet, the issue of mismatch is something which is there in financial liability side. The point that you are telling relates to the fair value option when we talk about financial liability. There is no such condition in case of fair value option of financial asset. So in case of financial asset, we have a fair value option that we can classify any asset at fair value through P&L. And the fourth type of classification possible is that all of the derivatives other than hedging purpose are also classified in fair value through P&L. But this is something that we are going to discuss when we are going to study the area of hedging. So I'm writing to be discussed with hedging. TBD means to be discussed with hedging, because someone may ask what is TBD. TBD means to be discussed with hedging. So in total, there are four possibilities through which an instrument can be classified in fair value through P&L. Either it may have a short-term intention, or it may be classified because of default category, or it may be classified using the fair value option, or it may be classified if it's a derivative other than the hedging purpose. Nayab is asking that I don't know where to ask questions. Nayab, you can actually ask your question over here. Randolph is saying, sir, an accountant won't be wrong to classify a long-term equity investment as P&L. Exactly, Randolph. You have got the point right. that if I have a long-term intention and I classify it in fair value through P&L, that's not wrong, because the fair value option rules allows us this type of classification. Hussein, we are going to discuss the further elaboration in the next slide. Next slide. So while I saying any financial asset can be written in fair value through P&L, please any short example of it. Sumaira, the answer is the answer of your question is very simple. Let's suppose that if I acquire shares of a company and my intention is to actually gain the voting rights of that company, to gain the control. I am acquiring shares of a company with the objective of obtaining the voting rights so that I can control that company, and I can make that company a subsidiary of mine. Now, my question is this a short-term intention or a long-term intention? Is this a short-term intention or a long-term intention? It's a long-term intention. So it should ideally be classified in fair value through OCI, but I want to classify it in fair value through P&L. So am I allowed for that? Am I allowed for that? The answer is yes, because the fair value option rules allows us to classify any financial asset at fair value through P&L despite of having a long-term intention. Merrick is saying, does IFRS 9 comes in on every exam? Merrick, almost every exam. Not every, but almost every exam, because this is a vast area, one of the most important areas and the most difficult accounting standard of entire SBR. So IFRS 9 is the most difficult area of the SBR which we are discussing today. That is why if you notice my speed is comparatively slow today, because this is something which we cannot cover in a hurry. So to cover IFRS 9, it is very important for me to be patient and go slowly. Salman Sarfar is asking, sir, are you angry with me? You don't reply to my questions. Salman, maybe your question was skipped. Can you send your question again, Salman? Okay, Johnson is saying after classified fairly through it can revert back to OCI. Johnson, this is something which we are going to discuss in the reclassification section. Your question will be discussed when we are talking about reclassification. Okay. Job is saying, does any financial asset mean we can take debt instrument too? Yes, Job, you're right. We can even classify debt instruments in fair value through P&L also. Okay, now on the next slide, we are discussing about the classification of debt instruments. So we are still on the classification of financial assets, but if we have acquired, let's say, the loan notes of another entity, now we can classify them in all of the three categories in fair value through P&L or fair value through OCI or the amortized cost. All types of classification are possible. If we want to classify it in the amortized cost, our intention should be to collect contractual cash flows, which means to collect interest and to collect the principal amount which we are going to get at the time of redemption. So if my intention is to hold the asset until maturity, if my intention is to hold the asset until maturity, only then we can classify it in the amortized cost category. If my intention is to hold the asset until maturity, then only we can classify it in the amortized cost category, which is also known as the business model test. Our business model, our intention should be to hold the asset until maturity, only then we can classify it at the amortized cost. Salman is saying, sir, are you from Karachi? There's heavy rainfall which disturb everything. Yes, Salman, I am from Karachi, and there is heavy rainfall going outside, but but in front of webinar, we have no option. We have to conduct it on time, irrespective of how we can come. So I think when we talk about media also shows a lot of negative picture, showing only the problems. So this is not the case for entire Karachi. There are places where it becomes difficult, but not every part. Okay, Marik is saying, I hope we go through all questions in relation to this topic. Okay. Ali Khan is saying, sir, convertible will not record under amortized cost because it has exactly Ali Khani, you are right. Now, in amortized cost category, we should have an intention to hold the asset until maturity. But if let's suppose my intention is to both collect contractual cash flows and then selling the financial asset, which means that I am going to hold the asset and then I am going to sell it off. In that case, we are going to classify it in the fair value through OCI category. So if my intention is to hold and then to sell, then we should be classifying it in the fair value through OCI. And if my intention was to hold only till maturity, then we should be classifying it to the amortized cost category. And if my intention is other than these two, then all other debt instruments will be classified in the fair value through P&L, which mainly means that my intention is to sell in the short term. In that case, we classify it in the fair value through P&L category. So if my intention is to sell in the short term, P&L, hold and then sell, OCI, hold till maturity, amortized cost. So the classification will change according to the intention. And when we say intention, we mean the business model. The word business model means the intention. The word business model means the intention. Abhay is asking that sometimes question like business model change will happen. What does that mean? Abhay, that means that if my intention changed later on, initially I was planning to hold, but now I have planned to sell in the near future. So my intention would be changed, which means my business model would be changed. Ahmad is saying, shouldn't it be for long term to be classified as OCI? Ahmad, when we are holding it for some years, this means automatically my intention is long term. So my intention is long term in OCI, but not till maturity. My intention is long term, but not till maturity, then we classify it in the OCI. And if my intention is long term and till maturity, then we classify it in the amortized cost category. Okay, Mohammad Ali, I will tell this later on. Yes, Abdul Qadir, you are right. Now the next thing is that to be classified in OCI and amortized cost, there is one more thing. To be classified in OCI and amortized cost, there is one more thing, which is that the timing and amount of cash flows should be fixed, which is known as the cash flow characteristic test. This is known as the cash flow characteristic test. So to be classified in OCI or amortized cost, the cash flow characteristic test should be passed for the debt instruments. Salman Sarfraz is saying that so there should be more. Okay, Salman, I'm ignoring your message right now. Ali Khan is saying for being OCI, it should pass three tests: business model and cash flow and fair value. Ali Khani, there are two tests only. To be classified in amortized cost, there are two tests: business model test and cash flow characteristic test. There is no third test for that. Sabha is asking what is CF test? CF test means cash flow characteristic test. Sabha, CF test means cash flow characteristic test. Johnson, cash flow characteristic test means that if an instrument has a fixed timing and amount of cash flows, it passes the cash flow characteristic test. So if an instrument has fixed timing and amount of cash flows, it passes the cash flow characteristic test. Okay, now we are discussing the accounting of the financial assets, and we have three categories: fair value through P&L, amortized cost, and the OCI. So this is what we have already discussed: the rules for the classification, the short term, the derivative, the default, the fair value option. These are something that we have already discussed. For OCI, our intention should be long term, but not till maturity. For debt, the next thing that we need to discuss is the accounting. In case of fair value through P&L, we initially record the financial asset at its fair value, which means that we should be recording the transaction cost in the P&L. We should be initially recording the asset at its fair value, and we are going to expense it, the transaction cost, to the P&L. However, in case of fair value through OCI, the transaction cost is going to be capitalized, which will bring the initial recognition to the cost. By cost, we mean the fair value plus the transaction cost. So because in case of fair value through OCI, the transaction cost was being expensed out, that is why the initial recognition was at fair value. So we can say that in all long-term categories, transaction cost is capitalized because it is going to provide us benefit for more than a year. In both the amortized cost and OCI category, which are long-term categories, we capitalize the transaction cost because we are going to gain benefit from the transaction cost for more than a year. So it is a capital expense. But in all short-term categories, we actually record the transaction cost as an expense because most probably we are not going to receive the economic benefit for multiple years. So based on this, we decide whether to capitalize or to expense the transaction cost. Now, in both the categories, the subsequent measurement is at fair value. In both the categories, the subsequent measurement is at the fair value, but the fair value changes are taken to P&L in the short-term intention and OCI in the long-term intention. So their names, fair value through P&L means carrying at fair value, taking the changes to OCI. P&L fair value through OCI means carrying the asset at fair value and taking the changes to the OCI. Abhay is asking what if the amount is variable? Abhay, if the amount is variable, the cash flow characteristic test will be failed, and we will be categorizing that at fair value through P&L. Mohammed Saqib is asking, sir, I am a bit confused about financial asset, which is a debt instrument. How should I treat? Later on would be treated as a change in estimate IS 8. Basically, Mohammed Saqib, if you're acquiring a debt instrument of another entity, you have to decide after how many time are you going to sell it. If you have no intention to sell, then keep it in the amortized cost category. If you are planning to sell it shortly, then keep it in the fair value through P&L category. And if your intention is to hold for a few years and then to sell, then you are going to keep it in the fair value through OCI category. This is how we decide the classification of the debt instruments. Mohammad Faizan is saying, sir, in fair value through OCI, business model test must be followed. Basically, the business model test means the intention. So if my intention is to hold and sell, this means this is the business model test for the OCI. Okay. Now the last thing is that the interest, dividend, and any gain or loss on disposal will be taken to the P&L for both the categories. So these two treatments are the same. The subsequent measurement is the same, and the treatment of the interest, dividend, and the gain or loss on disposal is also the same for both the categories. So on disposal, gain or loss on disposal, in both the cases, it will be taken to P&L because it is a realized gain. Both of these gains are in cash form. That is why anything which is in the cash form never goes to OCI. Anything which is in the form of cash never goes to OCI because the fair value changes are non-cash. That is why we have to think whether to take it to P&L or the OCI, but anything which is already in cash will always be taken to the P&L. Now the next thing that we are going to discuss is the accounting for the amortized cost, for which we are solving an example number 1. The question says that we have purchased a loan note, which is a financial asset for us, and we have purchased a 6% loan note with a par value of $100 million. This value will be the par value. And we have got a discount of $12 million. This means we have paid the amount of 12 million below par value. Discount means the value below par value. And we are going to get a premium of 3.92. This means we are going to get a value of 3.92 above par value on redemption. So normally we get a premium on redemption and a discount um, at the time in year 0. So normally we get discount in year 0 and we get the premium in the last year. Now the question further says that we have a transaction cost of $2 million. The maturity is 4 years. The market rate is 11% and the effective rate is 10%. Now can someone tell me what is the difference between the market rate and the effective rate? What is the difference between market rate and the effective rate? Mohammed Saqib is saying transaction cost. Okay, a lot of people are right actually. Basically, the difference between both the rates is the transaction cost. So normally what happens that if we see the coupon rate, which was 6% in this, if we add the discount and the premium in the coupon rate, that actually becomes the market rate. If we incorporate the discount and premium in the coupon rate, it becomes the market rate. And if we deduct the transaction cost from this, this will become the effective rate. So the main difference between the market rate and the effective rate is the transaction cost. Okay, so now we are going to solve the question, and the first entry in year 0 to recognize the financial asset is going to be bank credit and the financial asset debit by 100 millions of the par value minus 12 million of the discount. So we are going to recognize the financial asset at how much? At $88 million, which is financial asset debit and the bank credit by $88 million. But on the same date, we have paid the transaction cost as well. So should we capitalize this or should we expense this out? Should we capitalize this or should we expense it out? Ali Khan is saying capitalize. Krantivir is saying capitalize, capitalize, capitalize. One P&L. Basically, yes, the answer is to capitalize because this is a long-term category instrument. So in case of long-term category, we are going to capitalize that. So it is going to be bank credit and the financial asset debit. This means that the financial asset will now be recorded at $90 million in the financial statements. The next thing is that we are going to prepare a table for the next 4 years where the brought down for the first year is going to be 90 million, which we have just recorded. And the interest income will always be the effective rate. The effective rate is going to be the value for the interest income. Salman Sarfraz is saying financial asset is of 100, then why entry for 88? Because Salman, we have got a discount of 12. So we actually have paid 88 only. An asset is normally recorded at our own cost. So when my cost was 88, then why should I record it at 100? Laba, you can take the snapshot quickly. So now my interest income in year one is going to be $9 million, which is 10% of the brought down. But the interest received will always be the par value into the coupon rate, which was $100 million into 6% rate, which is $6 million. So this means that the amortization, the difference between the income and the amount received, is called the amortization. It will be 3 million. And my carried down of the financial asset will become 93 million, because my entry in year 0 is going to be that I have received an interest of 6, but my interest income was 9. This means that I should receive an additional $3 million of the interest in the later years. So we are going to use the interest income applied on the brought down and the coupon rate to calculate the interest received. Now in year 2, my brought down is going to be 93 and 10% of that is going to be 9.3, although I've received the interest of 6. So this year's amortization is 3.3 and the carried down will become 96.3. And this time in year 2, my entry is again bank debit by 6 million. Although my interest income was 9.3 million, this means that I should be increasing my financial asset, my receivable, by 3.3 million, because this is the interest which I should be receiving in the later years. In the third year, my brought down is 96.3 and 10% of that is going to be 9.63. Again, we received 6, so 3.63 is the amortization and 99.93 is the carried down in the third year. And finally, in the last year, 99.93 into 10% is going to be 9.99. We have received an interest of 6, so 3.99 is the amortization, and 103.92 is going to be my carried down. So the interest received will always be recorded at the par value into the coupon rate for every year, year 1, 2, 3, 4, every year. Interest received is coupon rate into the par value. Jagmeet, getting this? We are not going to apply 6% on 93. We are going to apply 6% on 100. Julie is saying, can you explain why brought down is 90 and not 88? Julie, because we have capitalized $2 million of the transaction cost as well. So it was 88 in the last slide. It was 88 and then we added an amount of, it was 88 and then we added an amount of 2 million into that. So this financial asset became at $90 million. So this is how we have got the 19. So now if we see, we were supposed to receive a premium of how much? 3.92 million at the time of redemption. And this is the value which is above par. And the par value was how much? 100. So ideally, I should be receiving 100 plus 3.92 at the redemption, which is going to be 103.92. And this is the same value as we have got in the last year. So we will automatically get the value of the premium in our working. So we do not need to manually include the working. It will automatically be included in the financial statements. Yes, Faz, the market rate is no use in the question until we are talking about a convertible loan note. Ali Khan is asking that what is the difference between market rate and implicit rate and coupon rate? Ali Kani, implicit rate is a rate which is used in the leases. There is nothing as implicit rate in IFRS 9. So we have only two rates, the market rate and the coupon rate. Market rate means the rate which everyone else is giving in the market. And coupon rate is the one rate which I am giving to you for the loan notes we have issued. So coupon rate is a specific rate for us. Market rate is a general rate for the entire market. Implicit rate is something which we have used in IFRS 16. Okay, now if I go back, there's one thing which we had actually discussed, that coupon rate plus discount plus premium is equals to the market rate. This is what we had discussed earlier. Let's suppose if in the question there is no discount and no premium. Let's suppose if in the question there is no discount and no premium, this means that the coupon rate and the market rate will be the same, because the difference between these two values is the discount and the premium. Similarly, if in the question there is no transaction cost, this means that the market rate and the effective rate will be the same, because the difference between the market rate and the effective rate is the transaction cost. So if there is no discount, no premium, no transaction cost, this means every rate is the same. Coupon rate, market rate, and effective rate all will be the same. So if there is no effective rate given in the question and there is no transaction cost, this means the market rate given in the question is the same as the effective rate. Is it clear to all of you? Okay, so now we have another example of the amortized cost, but this time the difference is that we are talking about an issued loan notes, which means it is a financial liability to us. It is a financial liability to us. Cindy wants a snapshot. Cindy, here you go. Okay, Milos is asking about closing entry. Milos, at the time of final settlement, the entry will be in year 4. The entry is going to be after the interest. First, we are going to make the entry for the interest, bank debit, financial asset debit, and the interest income credit by 9.99. And then we are going to make an entry as the bank debit and the financial asset credit by 103.92. This is the final closing entry in the year 4. Okay, Laiba is saying, please explain the capitalized concept. Okay, Laiba, I'm going to explain in a while again. Manur is saying if no transaction cost, then market rate is equals to effective rate. Exactly, Manur, you're right. Thank you, Milos. Mohammed Saqib is saying I have also checked the present value, par value plus premium equals to amortized cost paid 88, which is 100 minus 12. So should we calculate the market value of financial asset? Saqib, there is no need of calculating the present value in case of a simple loan notes, because that is what you are going to get back, which is 88. You're going to get the same value back. So now let's discuss the amortized cost category for the financial liabilities, because the accounting for financial asset and liability amortized cost is more or less the same. So let's quickly start this. We have a par value of 100, coupon rate is 5%, discount is 7, premium is 3.24, transaction cost is 3, maturity is 3 years, market rate is 9, effective rate is 10. So we do not need the market rate in case of simple loan notes. We are going to require that in case of convertible loan notes. So now, if we make the entry for year 0 for the financial liability, we are going to say that in this case, we are the party receiving the cash of 100 million of the par value minus the discount of 7. So we would have received an amount in the bank of $93 million. So $93 million is the value being recorded as the financial liability. But on the same date, we have even paid the transaction cost of 3 million. On the same date in year 0, we have paid the transaction cost of $3 million. So what should be the treatment of 3 million? Should we debit the financial liability or should we debit the P&L? What should be the treatment for this $3 million? Should we capitalize in the financial liability or should we record it in the P&L? Okay, so there are mixed answers. The correct answer is that we should be debiting the financial liability because amortized cost category is a long-term intention category. So we always capitalize the transaction cost, and capitalization means debiting the asset or the liability, and by debit we mean financial liability debit and the bank credit. So in any case, either financial asset or financial liability, the transaction cost will be capitalized. So this will result in the financial liability being measured at what amount? At 93 minus 3, because 93 was a credit and 3 is a debit. So the net value will be 90. Ali, can you not 96? It will be 90 because 93 is a credit and 3 is a debit. Salman, we will discuss the financial liabilities categories in a while. It is one of the presentation slides later on. So now the next thing is that we are going to prepare the table again. This is similar to the one that we have just done in the asset side, but the only difference is that we have interest paid now and the interest expense. Previously, we were having an interest income and interest received. In this slide, we had interest income and interest received, but in the current one, we are saying interest expense and the interest paid. So the table is going to be the same. The only difference is the names. Again, in year 1, 2, and 3, we are going to write 90 million is the brought down. Interest expense is 10%, which is going to be 9. But the interest paid will be at the coupon rate, which is 5% of $100 million, which is going to be 5. So the amortization is 4 and the carried down will be 94. In the second year, the brought down is 94 and 10% is going to be 9.4 with the interest paid of 5 again, which will result in the amortization of 4.4 and the carried down will become 98.4. And finally, in the last year, interest expense is 9.84. We have paid 5. The amortization is 4.84 and we are going to get a value of 103.24. And if we see, this will automatically be the par value plus the premium. So we do not need to record the premium. It will automatically be recorded in the table. If I go back, it was 100 plus 3.24. So it is 103.24 at the end. So now if I record the accounting entries, we're going to say that in year 1, we're going to make an entry as the finance cost debit by 9, but the interest paid from the bank is only 5, and the financial liability will be credited by 4. Similarly, in year 2, we are going to record the finance cost by 9.4, the bank credit by 5, and the financial liability by 4.4. And in the last year, year 3, we are going to record the finance cost by 9.84, the payment from bank of 5, the liability by 4.84, and this is the day when we need to repay the amount, redeem the loan. So we are going to pay 103.24 in the last year, which will eliminate our liability from the financial statements. So this is how we have recorded the entry for the financial liability. Mohammed Saim is saying when the transaction cost is capitalized, then why we have deducted? Saim, because capitalization means recording an asset, and recording an asset means debiting. So we are recording the liability at the net value. 93 is a liability, 3 is an asset, so the net value will become 90. Tamina is asking how do you get from 90 to 94? Tamina, the value of the carried down means brought down plus the value of amortization. So the brought down was 90 and the amortization was 4. So we have got 90 plus 4 is equals to 94. And how we have got 4? 4 is the amount of the interest expense minus the amount of the interest paid. So 9 minus 4 is equals to 4 and 90 plus 4 is equals to 94. Tamina, getting the point? Saud is asking what is the difference between amortization and lease. Saud, these are two exactly different things. So we cannot compare that. Amortization means the amount of the interest that we haven't paid. Okay, so now the next thing that we are going to discuss is going to be the convertible loan notes. We are going to discuss the convertible loan notes now. Convertible loan notes means a compound financial instrument. And the compound financial instrument means an instrument which has both an equity component and a debt component. So it is a compound financial instrument, which means having both components. And let's start discussing. So we have a convertible loan note with a par value of $100 million and a coupon rate of 6%. We have got a discount of 4. We will get a premium of 3. There's a transaction cost of 1. Maturity is 3 years. Market rate is 9% and the effective rate is 9.38%. And these can be convertible into 25 million shares after 3 years. Now, when we say that a compound financial instrument has both liability and equity, how do we break it into these two values? The method is that we simply calculate the present value of all cash flows discounted at the market rate. Discounted at the market rate. And the equity will always be the balancing figure. So this is the first case where we are using the market rate, which is the convertible loan notes. Otherwise, we can simply ignore the market rate in the question. Only in case of compound financial instrument, we use the market rate. So in this question, if I calculate the present value of all future cash flows, we're going to write year, cash flow, discount factor, and present value. So year 1, 2, 3 and year 3, because the life maturity is 3 years. The interest in 3 years is going to be 100 million into 6%, which is 6. And the redemption at the end is going to be 100 plus 3, which is going to be 103. So this is how we have calculated the cash flows, and the discount factor should be the market rate of 9%. So we need to calculate the annuity factor at the 9% rate. And the formula for the annuity factor is 1 minus 1 plus I to the power minus n divided by I. So this is how we actually calculate the annuity factor. So can someone tell me the annuity factor of this case? It's 2.531. Thank you, Abdul Qadir. So if we use 2.531, also the third year's discount factor, it's 0.772. Thank you, Abhaya. 0.772. So now if we calculate the present value, it is going to be 6 multiplied by 2.531, which is 15.186, and 103 into 0.772 will be, can someone calculate quickly? 793, 79.516. So now if we calculate the total, it is going to be 0.7024 and 94.702. So this is how we have calculated the amount of the financial liability. So now if I make the entry for year 0, and I am left with very less space. So in year 0, my entry is going to be bank debit, financial liability, and the equity credit. By what amount? Bank debit by 96, 100 minus 4, because we have given the discount. And the liability is 94.7. Let's calculate it to one decimal place, which means 1.3 is the amount of the equity. So bank was debited by 96, out of which 94.7 is the financial liability and remaining 1.3 is the equity. Now on the same date, we have to do one more thing, the entry for the transaction cost, which was $1 million. So we are going to credit the bank by $1 million, and the transaction cost will be allocated to both the financial liability and the equity. Now, how much out of one relates to liability and equity? The answer is that we need to break this proportionately between the liability and the equity. So this means that if I check 94.7 divided by 96, this means liability is actually somewhere around 98.645% of the total. So multiplied by 1 will be the amount allocated to the liability, which is 0.99 approximately. So we can say 0.98, let's say, will be allocated to the liability, and 0.0, let me check the exact value, it was 0.986. So let's call this 0.02. So 0.98 and 0.02 is what we have allocated to the liability and the equity. This means now in the balance sheet, the value of the liability should be how much? 94.7 minus 0.98, which is going to be 93.72. Please check my calculation. Sometimes my oral maths becomes horrible. And equity is 1.3 minus 0.02, which is going to be 1.28. Okay, thank you, Rida. Thank you, Tasbiha. Laiba is asking that why did we divide 94.7 by 96? Basically, Laiba, we are checking how much the liability is as a percentage of the total. We are checking how much the liability is in terms of percentage as compared to the total. So 94.7 divided by 96 is the liability percentage in the compound financial instrument. So we can say that liabilities is actually approximately 98% of the compound financial, and equity represents the 2% of the compound financial. Amara is asking, I'm confused at 1.3 equity. Amara, 1.3 is the balancing figure. 96 from the entry minus the 94.7 of the liability which we had calculated using the present value. So 1.3 Amara is the balancing figure. Crystal is saying, sir, I missed how you got 0.98. Crystal, I actually divided 94.7, the value of the liability, this one, divided by the 96, which was the total. So divided by 96 is the value of 0.9864. Abdul Qadir is saying, why not use 9.38%? Okay, Abdul Qadir, I will tell this to you. Plus, Abdul Qadir is saying, sir, financial asset we capitalize the issue cost while financial value we deduct. Exactly. Basically, Abdul Qadir, the treatment is opposite for financial asset and the liability. Alistair is saying, why don't we use the effective rate here as well? Okay, Alistair, I'm going to tell this in a while. Jagmeet is saying, sir, what then happens when at redemption? We are going to discuss this, Jagmeet. Salman is saying, if this scenario is a financial asset, we are going to discuss this, Salman. Right now, I'm trying to focus on this question rather than moving to some other questions. And a lot of questions still left. Why transaction costs are deducted, Hussain? Okay. Rosie is saying, okay, in case we have divided the transaction cost between equity and liability. Yes, exactly, Rosie. This is what we have done. Ilkar is saying that could you please make a short summary of the treatment of the transaction cost when expensed, when added, or when deducted? Okay, Ilkar, I will make it. Do remind me. Laiba is reminding that we have a break at 9:30. Yes, Laiba. Sardar is saying compound financial instrument could be financial asset. Yes, it can be a financial asset, Sardar. I'm going to tell the treatment in that case. Cindy is saying, sir, why do we calculate the percentage? Cindy, we have calculated the percentage because we need to divide, we need to break the transaction cost into liability and equity based on the percentage of the liability and the equity. Getting this point, Cindy? The more the percentage of liability, the more the transaction cost will be allocated to it. Amara is saying, so for loan notes, we don't capitalize transaction cost before splitting between equity and liability. Yes, Amara, that is why even in if you look at my previous examples, I have always made the entry for the transaction cost separately. Even in case of financial asset, if you go back, you see that I've made the entry for the transaction cost separately because sometimes it is added in the financial asset. In case of liability, it is deducted. In case of compound financial instrument, it is allocated. So there are three different treatments of the transaction cost. That is why I always write it separately. Crystal is saying, so 93.72 and 1.28 would be amount in the financials. Yes, exactly, Crystal. Sumaira is saying, sir, this whole entry will be written in compound financial instrument. Yes, Sumaira, this whole entry relates to the compound financial instrument. Now let's move on to the next slide so that we can complete this example and then we will be taking the break. Ram Ratan is saying, I can't get the value in the bank. Ram Ratan, the value in the bank is simple. It was the par value of 100 minus the discount of 4. The par value of 100 minus the discount of 4 is the value which we record in the bank balance. Manur is saying, why are these three different approaches to the transaction cost? Manur, because these are three different cases. So the application would be different in every case. So let's solve. We have already calculated the present value on the previous slide, so we don't need this part. We are simply solving this part. So the liability brought down was how much? If I go back, the liability brought down is going to be 93.72 in the table. So 93.72, and now we are going to use the effective rate. The interest expense will always be calculated using the effective rate, but the present value that we had solved will be calculated using the market rate. The present value will be at the market rate and the interest will be at the effective rate. Why is that so? I'm going to tell you in a while when I'm done with the calculation of this example. So let's use a calculator. It is going to be 93.72 multiplied by 0.938, in fact 0.0938, which is 8.79. Okay, so I'm not calculating, I'm expecting you people to calculate these values. And the interest paid is going to be 100 million into 6%, which is going to be 6. So 2.79 is the amortization, and the carried down is going to be 96.51. Do check my oral maths, because again there are sometimes blunders. So is the carried down right? 96.51. Okay, so now let me know the interest expense for year 2. 96.51 into 9.38%. It's 9.05. Thank you. 6 is the paid, 3.05 is the amortization, and 99.56 will be the carried down. So in year 3, 99.56 into 9.38%. Quickly, 9.34. Thank you. So 9.34 minus 6 is going to be 3.34, and now the sum is going to be how much? It should ideally be 103, because this is what we were expecting it to end. So it is going to be 102.90, which is approximately 103. So there's a rounding of difference in that. So this is how we are going to prepare the table in the later on. So if we see, the table is the same in case of financial liability and in case of compound financial instrument. The only difference was there in the entries for the year 0. But now there's one more thing. After year 3, the loan note holder has two options. Either they are going to demand for the cash, or they are going to demand for the shares, because we had given them the option. Salman Wasim is saying break time. We are going to take the break after completing this example, Salman. So we have two options. Either the counterparty will ask us for the shares, or they are going to ask us for the cash. In either cases, we are going to debit, or we are going to eliminate both the financial liability and the equity option. So in both the cases, we are going to debit the financial liability and the equity option, because once they decide any option, our obligation to deliver cash will be eliminated and the equity option will be eliminated as well. If we are giving shares, we are going to credit the share capital and the share premium. If we are giving shares, we are going to credit the share capital and the share premium. And if we are giving cash, we are going to credit the bank. So the liability is 103 at the end. The equity option was at 1.28, which we had solved earlier. And the share capital will be recorded at its par value of 25, and the balancing figure will become the premium, which is going to be 79.28 if I'm not wrong. So if the counterparty asks us for the shares, we are going to debit the liability and equity. We are going to credit the share capital by the par value which was given in the question of 25 million shares. By default, we assume a par value of 1. So this will become $25 million of the share capital, and the balancing will be the premium. Getting this point, Jagmeet? But if they have asked for cash, our entry is going to be, the debit will be the same, 103 and 1.28. The debit will be the same. Let me draw a line in between. But for the credit side, we are going to pay the bank balance of 103 only, because if they want cash, we are liable for 103 only. But now if we see the entry is not balanced, so what do? We actually recognize the gain on the equity option directly in the retained earnings, because equity option is an equity instrument and any gain or loss on equity instrument is directly recorded in the equity, which means retained earning. So this is how we recognize the entry depending on what requirement is there for the loan note holder. So any questions so far? Because now we'll be going towards the break. So if there's any question, you can quickly ask, and then we're going to take a break. Milos is saying what just happened. Okay, let me explain this again in the OneNote, because a lot of people are having the problem into this. Let me use the OneNote. Basically, what happened was we initially recorded the financial liability and the equity option. If I go back, the liability and the equity option were initially recorded at 93.72 and equity by 1.28. So 93.72 was the liability, and how much? 2.38 or 1.38? It was 1.28. So this is what we had recorded in year 0. And then we actually amortized the financial liability and we amortized it to 103 in the table. Is it clear so far that we initially recorded the liability at 93.72, which we amortized to 103? The equity option remained over there. Now, the loan note holder has two options, either to take cash or to take shares. If they ask for shares, my liability of 103 will be eliminated because I have given them the shares. And similarly, the equity option, because they have exercised it, it shall also be derecognized. So liability debit by 103, equity debit by 1.28 from over here. And we are going to credit the share capital and the share premium. The question mentioned that we will be giving 25 million shares. So the share capital will be credited by 25 and share premium will be the balancing figure. Balancing figure means 103 plus 1.28 minus 25, which is going to be 79.28. So this is how we make the entry if the loan note holder asks us for the shares. But if they ask us for cash, we are going to pay them 103 only, because this is what we had promised if they take the cash. But what about the equity option of 1.28? Because they actually took the cash, so their option has been lapsed, cancelled, because they have taken the cash. So it's a gain for us, and that gain will be recorded in the retained earnings. So these are two different types of entries that should be recorded based on what the shareholders or the loan note holders actually decide. Is it clear now, everyone? Okay, great. Thank you, Milos. Okay, that's great. Everyone have got the concept now. So now we are moving towards a break of 10 to 15 minutes, and it's approximately 9:38. So we are going to get back after 15 minutes from this. Yes, Sabah, issue of loan notes means the liability. Ashita is saying why retained earnings, Ashita, because it's a gain on equity, and whenever we talk about gain on equity, it is recorded directly in equity. Yes, Salman, in both the cases, liability and equity both will be eliminated. Yes, Salman, the examiner has gone into this much of details. This question is one of the past papers question which I have just solved. So let's take a break and then come back again. Okay, everyone, welcome back. And we were discussing the area of compound financial instrument before the break. And let's go through a summary of the compound financial instrument. The compound financial instrument is an instrument which has both an equity component and a debt component. The accounting procedure is that we are going to debit the bank by par value minus the discount. We are going to credit the financial liability by the present value of all cash flows discounted at the market rate, and equity is going to be the balancing figure. And then we are going to allocate the transaction cost by crediting the bank by the amount of transaction cost and debiting both liability and equity in the same proportion as the above entry. So the amount of liability divided by bank will be the percentage of the liability. That percent of the transaction cost will be allocated to the liability, and equity divided by bank will be the portion of the equity. That percentage of the transaction cost will be recorded in the equity. So this was the summary of the question that we have just solved. And the interest rate used in calculating the interest expense will always be the effective rate. Laiba is asking me to repeat this. Basically, Laiba, this is just a summary of what we had discussed before the break. So you can actually cover this easily later on as well, so that we can continue towards some complex areas. Now, the next area that we're going to discuss is the reclassification. Reclassification means changing the category um, to another category. Okay, one question which was frequently asked, that why are we using the market rate over here and why effective rate over here? Yes, Marek, you are right. Ashita, you can take the snapshot. So a lot of questions, a lot of people were asking that why we are using the market rate in the first entry and effective rate in the table. The reason behind this is basically, if I use the OneNote, that what is the difference between the market rate and the effective rate? Can you remind me that? What is the difference between the market rate and the effective rate? The difference was the transaction cost. Agreed? Now, when we calculate the present value of all future cash flows, we made a table of year, cash flow, discount factor, and the present value. We took year 1, 2, 3, and year 3. We took the interest in the cash flow and the par value plus the premium in year 3. Did we take the transaction cost in this? Is the transaction cost included in this entire process? Yes or no? No. This means that the transaction cost should not be there in the rate as well. So if I if I exclude the transaction cost from the interest rate, I will get the market rate. Getting the point? Like with like, if there is no impact of the discount of the transaction cost in the cash flows, then the rate should also exclude the transaction cost. But when we made the table here, brought down interest expense, interest paid, amortization carried down, the value we took in the brought down was the value from over here minus the transaction cost. Remember this. So this means that the brought down now includes the impact of the transaction cost. So the interest rate should also include the impact of the transaction cost. So it should be like with like. If no transaction cost impact in the cash flows, no transaction cost impact in the rate. Getting this, everyone? Aristotle has got the point. Abdul Qadir is asking, can we include the transaction cost into the present value? Abdul Qadir, you cannot, because we are taking the present value of future cash flows and the transaction cost is something incurred in the past. So we cannot calculate we cannot incorporate the transaction cost over here. Abhay is asking that are we going to discuss hedging in today's session? Yes, Abhay, we have the target of discussing the hedging. So let's quickly get back. Thank you, Manul. So now we are discussing the area of reclassification. When we talk about reclassification, this means either we are going from P&L to OCI or from OCI to amortized cost or from P&L to amortized cost or from amortized cost to OCI or from OCI to P&L. All these transfers will be called actually the reclassifications. So what accounting are we going to do in case of reclassification is the first thing that in P&L we can classify equity instruments as well as the debt instruments. In OCI we can classify again equity as well as the debt if the intention is long term but not till maturity. But in amortized cost only debt instruments can be classified, equity cannot be classified. So the first thing that we need to remember that equity instruments of another entity cannot be reclassified. Equity instruments of another entity cannot be reclassified. So this means we cannot take the equity from P&L to OCI. This is not allowed. So once an equity instrument has been classified, we cannot reclassify that. Once an equity instrument has been classified, we cannot reclassify that. This also means that only the debt instruments can be reclassified. So equity should be removed from over here. Now we are talking about the debt instruments only. Now the next thing is that if we are going from amortized cost to fair value, which means either fair value through OCI or fair value through P&L, what will we are going to remeasure the financial asset to its fair value, which means whatever the carried down was, we are going to remeasure this to the fair value, and obviously this will result in a gain or a loss, with gains and losses recorded according to the new category, which means if we are going to fair value through P&L, we should record the movement in the P&L, and if we are going to fair value through OCI, the gain or loss should be recorded in the OCI. So if we are moving from amortized cost to any other category, we have to record from the carried down to the fair value with the movements taken to the P&L or the OCI based on the new intention. And if we are moving from fair value to amortized cost, either from OCI to amortized cost or from P&L to amortized cost, the last fair value will be deemed, the word deemed means assumed, to be the amortized cost. We will assume the last fair value to be the amortized cost. And one more thing, that the reclassification is only allowed when there is a change in business model. This is only allowed when there is a change in the business model, and by business model we mean the intention. So if my intention has changed from long term to short term or from short term to long term, only then we are allowed to reclassify the financial asset. Okay, so now let's move on to the next slide. The next slide relates to the Okay, Salman Sarfraz is asking about any logic. Basically, Salman, there are logics, but as we are short of time, let's move forward because the examiner will not ask us the logic. So we actually also need to cover the hedging, and then we have some past papers planned. So rather than investing time onto the areas of logic, I'm focusing more on the rules. Okay, Laiba is asking, sir, can you explain fair value to amortized cost? Basically, Laiba, whenever we move from fair value to amortized cost, we assume the last fair value to be the amortized cost. So there will be no change in the carrying amount. Rather, from now onwards, we will start the amortization. So there will be no change in the carrying amount, only the accounting for the year is going to be changed. Yes, brother, we are going to touch the impairment area as well. Now the next area is the de-recognition of financial asset. In case of de-recognition, we say that we normally have a right to receive cash, which will either be exercised or will be lapsed or will be transferred to someone else. So if we have exercised the right, this means that we had a right to receive cash and now we have received it. So if we have received it, the entry is going to be bank debit and the financial asset credit. If we had a right to receive cash and now we have received it, the entry is bank debit and the financial asset credit, because now we don't have any further right to receive cash now. In case of lapse, if we had a right to receive cash, but we actually forgot to receive cash and the time has passed. This is something not professional. This shouldn't be there. But the accounting concepts actually includes all types of possibilities, whether they are found practically or not. So if the time lapses, we should be de-recognizing the financial asset, and that's a loss to us because we had an economic benefit, but we were not able to utilize that. And if we transfer our right to receive cash, there are two possibilities, that either the risk and rewards will be transferred or the risk and rewards will not be transferred. So if the risk and rewards have been transferred, we will actually de-recognize the financial asset. And if the risk and rewards are not transferred, we will not de-recognize the asset. Rather, we will be recording a financial liability instead of that. So either the risk and rewards will be transferred or will not be transferred. If they have been transferred, we will de-recognize the financial asset. If they have not been transferred, we will record it as a separate financial liability, and we are going to solve one of the past paper question for this as well in the later slides. Vishal is saying, why financial liability? Vishal, let me explain this in the next example. Nayab is saying, can you explain lapse again? Nayab, if I had to receive cash, let's say in 30 days, after which my right will lapse, and I forget to receive or collect the amount in 30 days, this means my right has been lapsed and I don't have any further right to receive cash. So this means it's a loss. We will credit the asset and record it as a loss in the P&L. Now let's have an example of factoring. What is factoring is basically that if we are a company and we sell goods to our customers, but we don't have time to collect the amount from them. So what do? We actually outsource or sell these customers' recovery to the factor. So let's say the company has made a sales of $10 million to the customers and has asked the factor to collect that amount from the customer. This means we have actually sold our receivables. Plus, we also ask from the factor that why don't you pay the amount to us today and you collect the amount from the customers later on. So let's say the factor says that, okay, but I will give you only $9 million because remaining $1 million will be my fees plus the interest that I'm going to charge from you because I'm giving you an advance payment. So the factor will charge two values, one as its factor fee and the second as the amount of the interest, because the factor is giving us the amount right now and we'll get it back after 1 month, 2 months, 3 months, or 4 months, depending on how soon the customer will pay it. Now there are two possibilities: that what if there is a bad debt from the customer side? Will that risk belong to the factor or the company? Now this has two cases. One is the type of factoring where the bad debt risk is transferred to the factor, which is called non-recourse factoring. And the other is where the bad debt risk is not transferred to the factor, but it is retained by the company, which is called recourse factoring. So if the bad debt risk belongs to the factor, this means that the risk and rewards of the receivables have been transferred. So in this case, we are going to make the entry as the bank debit by $9 million. And as the risk and reward of the receivables have been transferred to the factor, we should be de-recognizing the receivables from our financial statements. And on an immediate basis, we are going to record 1 million as an expense in the P&L. So because in this, the bad debt risk has been transferred to the factor, this means that the risk and rewards have been transferred. The entry is de-recognizing the financial asset, which means de-recognizing the receivables. But let's suppose if the bad debt risk belongs to the company. This means that if the factor does not receive the amount from the customers, we will have to repay this $9 million back to the factor. So we may be required to repay the amount to the factor. So that is why we call that the $9 million that we have received is actually a liability to us, because there's a possibility of repayment of that amount. Vishal, this is the reply to your question. That why are we recording it as a liability? Because the amount that we have received is not ours. We may be required to repay it back. Now, what will happen when the cash is received by the factor and the factor calls us that, hey, I have received the amount? At that point of time, we say that, okay, the amount has been received, so my receivables are no more, and similarly, my liability is also no more, because the factor has got the amount, the customer has paid the amount, out of which 1 million is an expense for me, because that is the amount the factor has charged as a fee. So in case where the bad debt risk is immediately transferred, we immediately de-recognize the receivables. And in case where the risk is not transferred, we are going to record the amount as a financial liability, because we may be required to repay it back. Any confusion so far? Okay, Alek Yani is asking, sir, please explain when cash is recovered by factor. Basically, Alek Yani, whenever the customer will pay the amount, this means that the factor would have received the amount. Like, for example, if I sell you the goods and ask you that you should be paying the amount in 3 months, but I don't have time to follow you up and receive the cash from you, so I sell this to a factor and I take the amount from the factor, and now the factor will follow you up and take the amount from you. So after 3 months, the factor will start following you up and you will pay the amount to the factor. So this is when the amount will be received by the factor. Saim is saying, sir, if risk is not transferred in the why we show bank as debit? Basically, Saim, we have received the amount in the bank, but we may be required to repay that if the factor does not collect it from the customer. Like, let's suppose that if I have sold goods to someone and I ask you that you pay me the amount and you can collect it from my customer. So the amount that I'm receiving from you is bank debit and a liability credit, because if my customer does not pay it to you, you will ask me to pay the amount back. So I've received the cash from you, bank debit, and I may be required to repay it back to you. Vishal is saying I got it when I saw the example anyway. Thank you. Okay. Abhay is saying what if the factor didn't receive cash? Okay. Jagmeet is saying, so in previous slide, why when the risk and reward not transferred, it is a liability? Jagmeet, the answer is there in this slide, that if we have taken amount but we haven't transferred the risk, this means that we may be required to repay this amount later on. That is why we are calling it a liability. Abdul Qadir is asking, sir, even if non-course factoring has exist, we still need to see the significant we transfer, right? If we just transfer 10% and guarantee to pay any default, then still we can't de-recognize it. Basically, Abdul Qadir, if you have given the guarantee to pay, this means that it's a recourse factoring. It's not a it's not a non-recourse. So in that case, we are going to record it as a liability and we are not going to de-recognize that. So non-recourse means where the risk belongs to the factor and there is no guarantee from our side. Salman Wasim is saying, sir, in recourse factoring, we consider the proceeds as a loan given to us. Yes, Salman, this is a type of a loan until the customer actually pays the amount. Okay, so all replies done. Now there's one more thing that we need to discuss, which is a sale and buyback agreement. And this is quite similar to what is there in IFRS 15 as well. So if we have an agreement, like let's suppose that if we are a party A and we go to B and we sell a financial asset to B for $100 million with an agreement that we are going to buy this financial instrument back for $110 million after 1 year. This means that we have got a sale and buyback agreement with B. We have got a sale and buyback agreement with B in which we are going to buy back at a fixed price. So in this case, we say that in actual, has the instrument been sold to B or not? Has the instrument been sold to B or not? The answer is no, because the risk and rewards have not been transferred to B. If the price of this instrument increased to 150 after a year, has B any gain of increasing the value? The answer is no, because B will only get 10 million additional. Because B will only get $10 million additional. Similarly, if the value decreases to let's say $50 million, will B result in a loss? The answer is again no, because B is going to receive 110 in every case. If the price increases, B will get 110. If the price decreases, B will get 110. So B has no gain or no loss. So we say that in case of fixed price, the risk and rewards are not transferred. So in this case, being A, we should be recognizing an entry as the bank debit by $100 million, and we should be recording it as a financial liability by $100 million. And the amount that we are paying extra of $10 million is actually an interest on this, which is $10 million. So this arrangement is a type of a loan arrangement of a loan agreement with B. It's a financing arrangement. Yes, Abdul Qadir, you are right. So risk and rewards have been retained by A in this case. But let's suppose if we have decided to buy back not at 110, but whatever the fair value will be after 1 year. Now if the price increases to 150, B has a gain. Now if price decreases to 50, B has a loss. So in case where In case where the buyback price is fair value, we say that the risk and rewards are transferred. The risk and rewards are transferred. So in this case, we are going to make an entry as the bank debit and the financial asset credit. And whenever after a year we buy back the asset, we are going to re-recognize that at that point of time. So this is the entry for year 0 and this is the entry for year 1. In case of fixed, this was the entry for year 0 and this was the entry for year 1. And when we buy back, we're going to write the entry as the financial liability debit by 110 and the bank credit by 110. So this is the accounting for the sale and buyback agreement that we have signed. Okay, so if you want a snapshot, you can take it quickly. So in case of derecognition, we need to check whether the risk and rewards have been transferred or not, and then we decide the accounting accordingly. So these are the entries that we have already just discussed on the OneNote. So let's move on to the next slide, which actually relates to the impairment. When we talk about impairment, we have an expected loss model for IFRS 9. Laiba is asking how the risk and rewards is transferred. Laiba, the risk and rewards is transferred because if I am selling goods to B for 100 million and I will buy back at fair value, so if the fair value at that time increases, B will have a gain. And if the fair value at that time decreases, B will sell it to me at a lower value, so B will have a loss. So the fair value fluctuation will result in a gain or loss to B. That is why we say that the risk and rewards have been transferred. So in case of impairment, we have a model which is called the expected credit loss model. In this, we have three-stage model: stage 1, stage 2, and stage 3. In stage 1, we classify the performing assets, where these are the financial assets who are expected to perform in line with the contract. So in stage 1, we are going to classify assets where we are expecting no loss. This is the stage where we are expecting no loss. So let's suppose if I have given loan to 10 different people and I'm expecting that everyone will give me the back will give me back the loan. This means all of my financial assets are in stage 1. Let's suppose that I've given loan to 10 different people and I'm expecting that every one of those 10 people will give me back the loan on time. This means that I have no loss on all these 10 loans. So that will become a stage 1 financial assets for me. Similarly, in stage 2, we are going to classify the assets where the risk has significantly increased, where we have a risk of loss. This is a stage where we have a risk of loss. The credit risk increases such that the credit quality is not low risk now. So this means I have a risk of loss, so this will be classified in stage 2. So let's say if I have given loan to 12 people and I am expecting 2 of them that they may default. So those 2 will be classified in stage 2. And stage 3 is the credit impaired where the default event has occurred. So in stage 3, we are going to write the instruments on which we have already faced a loss. So stage 1, everything is good, there's no loss. In stage 2, there is a risk that my asset may default and may result in a loss to me. Like I have given loan to Mr. A and I'm expecting that Mr. A is in financial difficulty and may not be able to pay me. This is my expectation. Mr. A has not said any such thing. It's my expectation that Mr. A is in financial difficulty and may default. So that will go to stage 2. And when Mr. A says that, look, I don't have any amount, don't expect anything from me, this means this will become a stage 3. So until the loss event occurs, it is stage 2. And if there is no risk, it is stage 1. But IFRS 9 requires us to record the provision even in case of stage 1 where we are not expecting any loss, but still we should be recognizing a provision for that. Rosie is asking, is this important to learn? Yes, Rosie, impairment and hedging are one of the most important areas that we need to discuss in today's session at any cost. Even if we have to stay 5-10 minutes late, we will cover these two areas at least, because these are the important ones of IFRS 9. Now, how much of the loss allowance will be recorded? In stage 1, we recognize 12 months expected credit losses. So at the time of initial recognition, we are going to recognize expected loss due to events that are possible, that are not probable, that are only possible within 12 months after the reporting date. So every instrument on initial recognition falls in stage 1, and even on that we recognize the provision, but that relates to only the next 12 months. We recognize a provision that relate to only next 12 months. But in case of stage 2, we record lifetime expected credit losses. This time we are going to take the losses relating to the entire life of the instrument. So this is the present value of the losses that arise if a borrower defaults on their obligation throughout the life of the financial instrument. So let's say the question says that there is a 30% chance of default on a customer. This means all of the cash flows that I'm going to receive from that customer into 30% is what I'm expecting as a loss. If the question says that there is a 30% chance of loss, this means that all of the cash flows from that customers into 30% is what is my expected loss. So we need to calculate the present value of that to get the lifetime expected losses. And the third stage is lifetime actual credit losses. This is not expected, this is the actual credit loss. So if my customer calls and says that, look, I had taken loan from you for 5 years, but I cannot give you the interest for the next 5 years, but I will pay your amount back on time. So I have given in loan to a customer for 5 years with a 10% interest rate, but the customer says that I won't be able to pay the interest, but I will pay the principal amount on time. So the 10% interest is what is my actual loss. So we are going to calculate the present value of the losses that have arose when the borrower defaults on their obligation. So the difference between stage 2 and stage 3 is in stage 2 we are expecting a loss, in stage 3 we have a loss. In both the cases we calculate the present value of the losses, but in stage 2 we calculate the present value of the expected losses. In stage 3 we calculate the present value of the actual losses. Now the last thing, that if we talk about the table, the year brought down, interest income, interest received, amortization and carried down. If we talk about this table, should the brought down be written after the loss allowance or before the loss allowance? The brought down that we write normally in the table, should it be written after deducting the loss allowance or should it be written before deducting the loss allowance? Okay, some people are saying after and some are saying before, a mixed answer. Okay, this SBR is telling the right answer. Basically, for stage 1 and 2, we are going to write the value before deducting the loss allowance. But in stage 3, we are going to write the value after deducting the loss allowance. In stage 1 and 2, we calculate the interest on the gross carrying amount, which means before deducting the loss allowance. So in stage 1 and 2, we use gross carrying amount, which means before deducting, but in stage 3, we use net carrying amount, which means after deducting the loss allowance. Because in stage 1 and 2, we are only expecting a loss, but in stage 3, we actually have a loss. So in stage 1 and 2, we are expecting a loss, but in stage 3, we have a loss. So in stage 3, we are going to use the net carrying amount, but in stage 1 and 2, we are going to use the gross carrying amount. Yogesh is asking, sir, in stage 3, if the loss is actual loss, then do we need to calculate the present value? The answer, Yogesh, is yes, because let me go back to my example that I had given a loan to someone for 5 years, and the person says that he won't be paying me the interest for the 5 years. So the interest for year 1, year 2, year 3, year 4, and year 5 is a loss. And all these 5 years will be having different time value of money. So it is necessary to calculate the present value in this case. Okay, good. So any confusion in this? Now let's move to the next area of hedging. Now we are discussing the area of hedging, but to start hedging, we have to start it from the derivatives. Now, what exactly is a derivative? Derivative is a financial instrument with the following characteristics. Derivative is a financial instrument with the following characteristics. The first is it does not have its own price. It does not have its own price, rather its price is determined from some other underlying instruments. So derivative is a contract which does not have its own value. Now let me give you an example. That let's suppose I'm an entity A and my business is to import laptops. My business is to import laptops and sell it locally. But I have a risk. What if the price of the laptops increases in the international market? I have a risk that if the market values increases in the international market, I will have to pay additional amount. So I call my supplier, which is B, let's suppose, and I say, look, that I am currently buying the laptops at, let's suppose, $100 per unit from you. I want to sign a contract, a forward contract, that I'm going to buy these laptops from you at $110 per unit after 2 months. So it's sort of a 2 months forward contract where we have locked a price of 110 after 2 years. Now let's suppose that after 2 months, the market value of these laptops rise to $150 per unit. And according to the contract, I am going to buy them for how much? 110. So this means how much value do I give to this contract? What is the value of the contract? What is the value of the forward rate agreement? The value of the forward rate agreement will be how much? This we are saying 110, Anita is saying 110, Jagmeet Hibakar Aunty is saying Kranti is saying 40. Abdullah Qadir is saying 110. Basically, the value of the contract will be 40 because I have a gain of $40 per unit on this. So the value of the contract is going to be 40. But what if the market value is, let's say, $170 per unit? Now, can you tell me the value of the contract? If the market value of the laptops is 170 in the market, what is the value of the contract? This means 170 minus 110, the value will be 60 per unit. But what if I don't tell you the market value of the laptop? Now, can you tell me the value of the contract? If I don't tell you the market value of the laptops, can you tell me the value of the contract? The answer is we cannot value the contract on a standalone basis. We need some other underlying instrument. Getting this point? That it does not have its own price. We cannot value that as a standalone. We are going to use some other value, the 161, the 110, the 151, or the 171 to calculate the market value, because the derivative does not have its own value. Rather, we actually derive its value from some other instrument. Getting the point, everyone? Randolph is saying, is there any fee paid on signing the contract? Yes, Randolph, there is normally a minimum transaction cost for that. Normally, in case of forward rate agreement. Abdul Qadir is saying that means the value of derivative changes when the value of underlying item changes, right? Yes, exactly, Abdul Qadir, you have got it right. Salman Sarfara is saying, so why we compare to the market value? Salman, because the laptops, if I would have not signed the contract, I would have purchased it for 150. But because of the contract, I'm getting it at 110. So the gain to me because of the contract is actually $40. So this is why we are actually comparing it with the market value. Laiba is saying, sir, can you explain again what will happen if there is no market value? Laiba, if there is no market value, we cannot calculate the value of the contract. We cannot calculate the value of the derivative because the name derivative means deriving from somewhere, calculating from somewhere. So its name is its characteristic that it does not have its own value. Rather, we actually calculate its value from somewhere else. Now, the second point is the initial investment is very low or zero. This means the cost of entering into the derivative contract will either be very low or it will be zero, and rather it will be settled at a later date. It will be settled at a later date. Yes, Nayab, if the market value is 90, this means the value of the contract is going to be negative 20 because the derivative can have a gain or derivative can have a loss. Cindy is saying, would underlying instrument always be the market value? Yes, Cindy, will be taking the market value of the underlying instrument every time. Okay, now there's one more thing which is very important. One more thing which is very important and very much confusing. So we have to listen that carefully. So I'm opening the OneNote again. And I'm writing down my example again. That I am A and I go to B and I say that, look, I purchase laptops from you at the rate, at the spot rate, today's rate, which was $100 per unit. And we are making a forward contract, a forward rate agreement for 2 months forward contract, where we are locking a rate of how much? $110 per unit. Now this is what we have logged, and the market rate actually increases to any value. Now my question is, according to this example, is this forward contract, is this forward contract a financial instrument or not? Is this forward contract a financial instrument or not? We are making a contract with the supplier that we are going to purchase laptop from you after 2 months. Okay, everyone is saying yes, and Algar is saying no. Alistair is saying no. Abdullah Qadir is saying yes. Everyone else is saying yes. Basically, the answer to this is no. This is not a financial instrument because we have signed a contract to purchase laptops. Laptop is a non-financial instrument. So if we are signing a forward contract of a non-financial instrument, this will not be a derivative. Unless there is one condition which needs to be met for it to be a derivative, but I'm going to go over there. So first thing that we need to remember, that whenever we sign a forward contract or a future contract or an optional contract or a swap contract, these are all normally derivatives. But whenever we sign a contract, we need to check whether the contract relates to a financial instrument or not. If the contract relates to a financial instrument, we call this a derivative. We call this a derivative. But if the contract relates to a non-financial instrument, we call this a non-derivative. Why? Because if you see in this case, what is my asset right now? What is my asset right now? According to the contract, what is my asset? No, Tasbih, it is not the laptop right now. My asset is the right to receive the laptops. According to this forward contract, I have the right to receive the laptop. So right to receive the laptop is not a financial instrument. Similarly, B has an obligation to deliver the laptop. So right to receive cash is a financial asset. Obligation to deliver cash is a financial liability, but right to receive laptop or obligation to deliver a laptop is not a financial asset or a financial liability. That is why we are saying that this contract is not a financial instrument. Getting this point, everyone? This is a difficult concept for even me to explain. So if the contract relates to a non-financial instrument, that will not be a derivative until now there are two possibilities in this, that if the contract relates to a non-financial instrument, either it is going to be settled in goods or it may be settled in cash. Abhay is saying to repeat. Abhay, basically my point was that if I have signed a contract with you that you are going to sell me 2 laptops after 2 months. You will sell me 2 laptops after 2 months. What is your obligation? Your obligation is to deliver laptop. My right is to receive laptop. Now, right to receive laptop is not a financial asset. Right to receive cash would be a financial asset. Similarly, your obligation to deliver laptop is not a is not a financial instrument, but your obligation to deliver cash would be a financial liability. So the point is that we have to see whether the contract is a financial asset or not. Jagmeet is saying, sir, A will pay cash and B will receive cash. Yes, Jagmeet, A will pay cash after receiving the laptop. Right now, A has no obligation to deliver cash until A receives the laptop. So at this point of time, when we are signing the forward contract, at that point of time, A does not have a financial liability to pay cash. So if we are signing a non-financial instrument contract and we are planning to settle that in terms of goods, then we say that it's a non-derivative contract. Then we say it's a non-derivative contract. And if we are going to settle such contract in cash, it will again become a derivative. Like let's suppose the market value reaches $150 per unit, and I call the supplier to say that, look, I don't want the laptops. I don't want the laptops. But according to the contract, I would have bought it at 110 instead of 150. So it was a gain to me of 40. So transfer me the $40 per unit cash instead of the laptops. So sometimes there are contracts which allow net settlement in cash. So if the contract allows the net settlement in cash and my intention is to settle in cash, that will become a case of derivative. Otherwise, it will be a case of non-derivative. And if it's a case of non-derivative, it will go to IES 37 and we have to check whether the contract is an onerous contract or not, whether it's a loss-making contract or not. So let's suppose that the contract does not allows net settlement in cash. Either take the laptop or leave the laptop. You cannot demand cash. Let's suppose in this example, there is no option to settle in cash. This means it's a non-derivative. This means it's a non-derivative because we cannot settle in cash. So let's suppose the market value now reaches $90 per unit. We have no option to settle in cash. We will be taking goods in any case. And the market value reaches $90 and I have to buy at what amount? 110. This means I have a loss of $20 on the contract on a per unit basis. So this means it's a loss making contract to me, and loss making contract is known as the onerous contract. So in such case, we will be required to make a provision for the loss of $20 per unit. So in case of forward contract, future contract, options and swaps, we actually need to check whether the contract is a financial instrument or not. If it's a financial instrument, it's a derivative. If it's a non-financial instrument, then we need to check whether it can be settled in cash or not. If it can be settled in cash and my intention is to settle in cash, it will become a derivative. And if my intention is not to settle in cash, it's a non-derivative. And in that case, we will be required to account it for under IAS 37 and check whether it's a loss-making contract or not. If it's a loss-making contract, we need to recognize a provision against that. Nayab is saying it is too much to digest. Yes, Nab, I know that it is really too much to digest because these are a lot of complex concepts that we are discussing. Halkar, let us solve an example for that and then we are going to understand it better. Alistair, this is something that is the decision of ACCA and not actually mine. Okay, let's discuss one of the past papers question, which is a past paper of June 2018, question 3 by the name of Darled Part B. Yes, Salman, actually the problem is that these are really complex concepts, so not everyone is going to tell you these areas, and even it is very difficult to make someone understand so complex workings. So let's solve one of the past papers questions. Manur, I will go back to the slide in a while because we have only 7 minutes left. Okay, take the snapshot quickly. All of the students who haven't taken the snapshot, take it quickly so that we can solve the question after this. Okay, so back to the question. The question says that on 1st September 2016, Darlet entered into a fixed price forward contract to purchase 2,000 tons of steel. Steel is a non-financial instrument. So we have signed a forward contract of a non-financial instrument. So up till now, it's not a derivative. At 400 euros per ton, the local currency is the dollars, and the purchase is in accordance with its normal usage requirement. So apparently, if it's my normal usage of consuming 2,000 tons of steel, apparently this means that I would be settling the contract in the goods, because my objective is not to earn money. My objective is to use it in my business operations because this is my normal usage requirement. The contract allows Darlit to take delivery of the steel on 31st August or to pay or receive net settlement in cash. So the contract allows us to settle the contract in cash. But what is my intention is more important. The contract allows, but if I have no intention of settling in cash, it will be a non-derivative based upon the change in the value of steel, but not on the change in the foreign currency exchange rate. Darlet has not settled similar contracts in past before delivery of the steel. So this is the second point, that my past practice is to settle in goods. So this is the second point that is supporting that most probably now also I will settle in goods. Darlet does not have a foreign currency contract to hedge against any risk caused by the movement in the dollar euro exchange rates. This means that I'm exposed to the exchange rate risk, and has paid a non-refundable deposit of 100,000 euros at 1st September 2016. The following exchange rates are relevant. The rate was 2:1 and now it's 1.75:1. Salman Wasim is saying I was in June 18 attempt and this part was an alien to me. Yes, Salman, but this time it is not going to be an alien now. There has been no change in the contract price of steel at 31st August 2017. So steel prices have not changed, and is felt that the decline in the dollar euro exchange rate is unlikely to be reversed. So the decline in the rate is unlikely to be reversed. Now the question says that the directors of Darlet would like advice on how to account the above contract and whether it is within the scope of IFRS 9, together with any implication of the change in the dollar euro exchange rates. So now the question is that, is this contract a derivative or not? The answer is no, because there is nowhere written that our intention is to settle in cash. Rather, it's a normal usage requirement for us, and we have never settled any such contracts in the past. So based on these points, we can say that we are expecting the contract to be settled in goods, and therefore it's a non-financial instrument. And if it's a non-financial instrument, we have to apply IAS 37 onto this. So we actually had a contract of purchasing 2000 tons of steel at a price of how much? $400 per ton. So this means that 400 euros per month, sorry, 2000 tons of steel into 400 euros. This means that we have a contract of how much? 800,000 euros, out of which we have already paid 100,000 euros. So my liability is now how much? 700,000 euros. This is my commitment to pay. Now the rate was originally how much? $2 per dollar. So in terms of dollars, my liability was $350,000. But now the rate has changed to 1.75 according to the question. Now the rate has changed to 1.75. So if we divide it by 1.75, 700,000 divided by 1.75 is going to be $400,000. This means because of the exchange rate, I would be at a loss of how much? $50,000. So a provision of $50,000 should be recorded, as the contract is an onerous contract, as it is resulting in a loss, which loss we are not expecting to be reversed. So this is how we have to identify the financial instrument being a derivative or not, a forward contract being the derivative or not. So we have to check whether it is going to be settled in cash or it is going to be settled in goods. If it is going to be settled in goods, it is a non-derivative, and we have to check as per IAS 37 whether the contract is onerous or not. And if it's going to be settled in cash, it is going to be a derivative accounted for accordingly. Saud is asking, why isn't it hedging? Saud, basically, if it's a derivative, then it will go towards hedging. But if it's a non-derivative, it cannot be a hedging. We cannot hedge a transaction without a derivative. Saim is asking, how do we record 350,000? Saim, 350,000 will be disclosed in the financials because it is just a commitment. It's not a liability right now. It will become a liability when we actually receive the goods. Randolph is saying, can the non-derivative that's supposed to be settled in goods be sold to another party cash? Yes, Randolph, it can be sold to anyone else. Salman Safraz is saying, please repeat the case of settlement in cash. Salman, we don't have time now to repeat. Sean is saying half this of this type question, then we are done. Didn't get your point, Shovan. Saus is saying, is it new? Yes, basically, Saud, it is not something very much old. After IFRS 9 being updated, this was being introduced. Salman is saying, please increase timing to complete this topic. Basically, Salman, actually, this is something very difficult to be discussed right now because I have to take approval from the ACCA beforehand. In fact, I have taken the approval for tomorrow to extend it to 15 to 20 minutes than the normal. So we will be extending the session most probably tomorrow to complete the important areas, which includes the framework, current issues, ethics, and the analysis. So quickly looking at your question so that I can reply to the most important one. If there was a financial, do we recognize on financial statements? Basically, the commitments, this $350,000 is a commitment. This is being disclosed in the financials and not recorded because it is not a liability so far. Okay, so thank you everyone, and I hope IFRS 9 was being understood properly. And I know it's a difficult one, and I tried my best to make it easy, but I don't know how much successful I was. Anyways, looking forward to meet you all tomorrow. Tomorrow is going to be the last session. Till then, thank you, take care, and Allah Hafiz.